Hi, my name is Justin Brown. I'm the Director of Investments here at Greenspring Advisors and lead Greenspring's Investment Committee. Today I'll be discussing highlights from the third quarter of 2024. Starting with market performance for the quarter, all major asset classes saw positive returns. Global real estate led the way, up 16%, while stocks in emerging markets, developed markets, and the U.S. all delivered above average returns. In the bond market, both U.S. and global bonds performed well. The strong bond returns were largely driven by changes in interest rates, as rates fell in anticipation and in the aftermath of the first Fed rate cut since 2020. Looking at longer-term returns, we continue to see positive performance across all asset classes over the 1, 5, and 10-year period. Nearly every asset class experienced double-digit returns for the past year. Over the past 5 and 10 years, we faced no shortage of events and negative headlines that could have made investors hesitant, from wars to a global pandemic to rapidly rising inflation and more. Despite these challenges, markets have demonstrated resilience over time, underscoring the importance of staying invested. Shifting gears a bit, with much attention on the Fed and what will happen with interest rates, we wanted to discuss what it actually means for the Fed to cut rates, the impact it has, and some potential investment implications. So what has happened so far? After raising rates at one of the fastest paces in history, and much speculation about when they would start cutting rates, the Federal Reserve made its first rate cut in September, lowering rates by 50 basis points, which is 0.5%. When the Fed cuts rates, what they are doing is reducing the federal funds target rate, which is the rate banks charge each other for overnight lending. The Fed's interest rate policy is important for consumers because it also influences, either directly or indirectly, things like credit card interest rates, student loans, home equity lines of credit, small business loans, mortgage rates, and more. Rates coming down often mean these areas of the economy feel some relief, as lower interest rates leads to lower payments. Because of this, as rates fall over time, investors should review their outstanding debt obligations. If you have loans or mortgages that you started within the last couple of years, you should keep an eye on whether or not you can refinance those loans into lower rates. For example, a 30-year mortgage started a year ago likely had a rate of around 7.5%. Today, rates are approaching 6%. Actively working to reduce your debt payment can improve your overall cash flow available for saving, so it's important to continuously evaluate your situation as the interest rate environment changes over time. As it relates to investments, many people took advantage of higher rates over the recent years by holding excess cash in high-yield savings accounts, money market funds, CDs, or similar cash-like investments. The chart below shows how yields on these cash-like investments move in tandem with the federal funds rate. While these investments have been a great way to earn 5% with minimal risk over the recent years, the Fed cutting rates means these yields will also trend downward, reducing the benefit and return on investment that these assets provide with each corresponding Fed rate cut. So what can you do to help navigate this? We believe that investing in a well-diversified investment-grade bond portfolio can help mitigate these lower yields and reinvestment risks. There are two main reasons for this. First, just as cash equivalent investments were able to earn higher yields when the Fed raised rates, bond yields have benefited too, and now are much higher than they were before the Fed began to hike rates in 2022. Second, bonds also offer an additional advantage. When interest rates fall, bond prices rise, boosting bond fund returns. This is different from these money market, high-yield savings, and CD-type investments, where lower rates simply result in less yield and no price increases to help boost investor returns. In summary, the Fed began cutting rates in September, and current data suggests more cuts may follow in the coming months or years. While the path forward is uncertain, we believe the backdrop of falling interest rates increases reinvestment risks for those holding a sizable amount of cash in short-term cash-like investments. Moving that cash into a well-diversified bond portfolio could be an effective way to mitigate the risk of lower yields, adding value to your investment portfolio and hopefully better positioning you to achieve your financial goals. On behalf of the Investment Committee here at Greenspring Advisors, I want to thank you for your time today. As always, please feel free to reach out to us with any questions.